Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The past week can be well summarized as a convergence of market expectations and Fed narratives. Higher for longer rates is being digested by the markets, and we are seeing a comeback in dollar strength. However, geopolitical tensions continue to brew across the world. US Secretary Anthony Blinken has now warned China against supplying weaponry to Russia in its fight against Ukraine, adding to the existing strain in their relationship. Iran also seems to have enriched their uranium to a level not far away from the requirement of nuclear weaponry. The path of geopolitics are dynamic and complex. We don't have a central bank coming up with forward guidance, but just thoughts on how things will play out. Morning, JK. I would like to know from you your thoughts on geopolitical front and the markets.
Good morning, Swaraj. Yeah, it's as you said, there is certainly no clear view that we can take on geopolitics. Just as Russia supplying arms to, China supplying arms to Russia is being protested. I think there is also protest from Russia for countries like Germany supplying, weaponry to Ukraine, actually, which is increasing the tension. So more than the Iranian side, I'm still looking at the Russia-Ukraine region where post-winter, many people are expecting action to begin on the battlefield, and that is what Ukraine is positioning itself for. So geopolitics will never keep you, at peace, and we need to be alert when the action begins. Yes, these statements and protests will just need to be digested for now, but not really for taking any particular view on the market until we see an action. But back to the near-term developments. On Friday, it was a relatively quiet session for the markets ahead of US holiday today for the President's Day. Markets absorbed some of the mixed comments from Fed's Barkin and Bowman. But the moves were more towards keeping the positions, though it was a day when market latched on to slightly dovish comments and ignored the hawkish comments. This is due to the market positioning, even as 10-year yield had rallied 63 basis points, 5-year by 73 and 2-year by 68 bps from the lows seen, in November. And these are like this yield movement is something that is really going and influencing the markets to a great extent in the absence of major trend setters. In fact, Richmond Fed President cited seasonals as overstating the recent strength in hiring and spending, referring to big beats in January jobs and retail sales. So that is when the higher yields lured strong buying back of bonds on Friday, leading to more speculative short covering. Barkin also poured some cold water on 50 basis point hike, which some people are suggesting, saying that I like 25 basis points because that gives flexibility to the central banks in terms of the policy tightening. Market, in fact, ignored Summers, who is always known to be a hawk, and he was saying consumer prices could climb close at a pace to 7%, and that's the fastest in 4 decades. And he's not in favor of Fed loosening its grip on the market. So all this led to market, not being in a mood to sell the bonds as highs were seen already in the yields, and the somewhat weak leading economic indicator index, which was published by the conference board, showed another decline by 0.3%, although in line with the expectations. But the manufacturing new orders, consumers' expectations, business conditions, credit conditions were all more than offsetting the strength in the labor market. So that could have triggered some sort of short covering in the currencies against the dollar. The markets are now currently pricing in a terminal rate of 5.28%, which is now nearly 50 basis points higher than the lowest they had assumed for the year. That was near about below 4.8%. And now only 22 basis points worth of cut is being priced in half to 23, and that is also really coming down. Stocks, however, could not shake off the hangover of strong economic data that was seen recently, sparking talks of rates going to 5.25 or maybe 5.50, according to some analysts. In fact, a few leading investment bankers are predicting 3 more rate hikes, and that's the highest I have heard, by the Fed. And of course, we will look to see if the FOMC minutes to be released on Wednesday night throws up some more clues, because we will get individual members' statements, which was recorded during the meeting. On the European side, official comments were somewhat contradictory. Schnabel said broad disinflation process is not even started, while Mr. Villeroy from France was more measured, noting it is likely we will reach the terminal rate by summer, which technically ends in December. So the contradictory statements and not really helping set a direction for the euro. Focus on FOMC minutes on Wednesday, then PCE core inflation, ZEW and FO survey for Germany, and the core inflation and BOJ chiefs hearing in the lower house of parliament on Friday. These are things that will keep the attention of the market in this week. Incidentally, UK's retail sales surprised in January with a higher number of 0.4% versus minus 0.2%. So we have seen some position adjustments in equity, in stocks and yields, as well as the dollar. But dollar's overall down uptrend is not threatened because we have had very large move down in the dollar from the high of September, and that is set to continue, possibly awaiting some triggers as we get into more data this week. On the domestic side, rupee is still stuck in a very narrow range. Been hearing of active central bank selling at the highs, but the market also is seeing good demand on dips, and it's really down to flows. If we do see any large outflows, we can see 83 being tested. But again, we are hearing central banks very keen to arrest any further weakness in the rupee. There were reports that the central bank was also active in the offshore market. So we really are looking at a very narrow range for the rupee until we get some trigger from either the stock market or in the global scenario. Thank you.
Thank you, JK. And just to summarize, we discussed developments on the Russia-Ukraine situation, with US protesting a potential Chinese weapon supply to Russia. Yield movement continues to influence the market with seemingly no willingness to sell the bonds. Terminal rate expectations are now at 5.28%. Earlier, it was at 4.8%, so quite a steep move up, while INR continues to trade in a range with active central bank intervention. That's it for today. Thank you so much for listening. Keep managing your risk. As we keep saying, we'll see you all tomorrow with the latest round of updates. Thank you.